Hello, and welcome to the Laddercast, where we teach you how to leverage your assets to change your life. I'm Sorsha Porter, and in 2016, I bought my first home, which completely changed the trajectory of my life. I turned that property into a business, a trip around the world, a new career, and quadrupled my household income. And now I'm a real estate agent licensed in Oregon and Washington.
And I'm Shannon McAllister. After finishing college with a degree in finance, I was in a job I hated but couldn't quit because I wasn't making enough money. I signed up for a class to learn about mortgages taught by a real estate investor. 17 years later, I'm a nationally licensed mortgage lender, homeowner, and investor myself. We aim to educate how getting on the property ladder by owning just one home can change lives. It changed ours.
Welcome back, and thanks for listening. Today, we have a special guest, Scott Porter. He is a CPA specializing in real estate. He is also a certified BONKA #1 grandpa to my niece Letty and my nephew Rhett. And in case you didn't guess by that, he's my dad. Thanks so much for joining us today, Dad.
My pleasure.
Today we're going to ask him some questions, go over some things that we hope our listeners are considering as they look for a professional CPA to support them in their journey. Right, Shannon?
Right. As we have gone over repeatedly, it's very important to have a team of professionals helping you if you want to go down this road, and finding the right people that do the right things is very important. They know things that you don't know. And so we're going to ask him all of those things that he wishes that we did know and that we were getting right so that you can do it right going forward.
Awesome. So, Dad, let's start off. Can you tell us a little bit about who you are, what your CPA practice is, and so on?
Well, I'm a CPA licensed in California and Colorado. My primary office is based in Colorado, but I have an office in San Rafael, California as well. I have been in public accounting for, 33 years, and I have been a sole prac for 23 of those years. I specialize in real estate, estate and trust, and small business. Real estate taxation probably makes up about 35% of the work that I do.
Amazing. Now, what does it mean to be a CPA that specializes in real estate?
Well, to me, it means understanding the taxation rules that relate to rental property, whether it's commercial or residential, being familiar with the client situation so that we can optimize their taxes and assist them in retaining more of their money every year. It also requires an understanding of the fact that it's not the transaction that leaves you with the least amount of tax. It's the one that leaves you with the most amount of money.
I like that.
That's excellent. And I think from that, I take away that not every CPA works under those premises. Not every CPA knows how to maximize real estate tax dollars. It's a specialty and niche that you have to work at.
Yeah, I know a handful of CPAs who are really good at it. And I've interacted with a lot that think that the process is all that it matters, is to put the information in, apply the rules they think that fit, and then move on without considering what benefits the client the most, because we're really supposed to be providing value. There are a lot of accountants who got into accounting because they want everything neat and in the correct box, and that's something that they focus on. There are a lot of accountants that are extraordinarily creative, some a little bit too creative, and the rest of us who are just, we're about value. We're about serving our clients, making our clients money and making ourselves money at the same time. And when both parties make money, it's a good deal.
And do people who own real estate versus people who don't generally make more money overall in life?
I would clarify that more as people who invest in rental property and hold for an appropriate time will typically make more money than people who don't. Those who focus on 401k and retirement plans and not focus on the other aspects of investing and having multiple sources of revenue from which to draw on later tend not to accumulate as much money, or they've accumulated a lot of money that every time they need it, they have to pay. Not only do they need the money for the expense that they're charging, they need the taxes to pay for that money. So if you're in a 40% tax bracket in California and you need a new roof that costs $50,000, you need approximately $120,000, $100,000 out of your IRA to cover all that. Maybe closer to 92. So it's not. Real estate allows you to accumulate wealth. It allows you to use your equity in times where it's much more efficient than using a retirement fund or other earned income. And it also allows you to leverage some things to continue investing appropriately as new deals and new opportunities come up.
Amazing. Do we use someone like you if we own just one home? Would you recommend people who need a CPA if they just have a single family residence that they live in?
Do they need your skills and expertise?
They do if their time is valuable. So in some circumstances for a family, a couple with 2 kids who have W-2 jobs and they own their own real estate, especially in a higher end area like the West Coast, they may need a CPA to help maximize the deductions for their Schedule A. If they don't, and they don't make the kind of expenses to have itemized deductions, it may be simpler for them to go to H&R Block or Liberty Tax Service or an enrolled agent. I have a lot of people that have come to me from those organizations, and they're willing to pay the premium to have me do it correctly.
Nice.
Is there we get that. That's wonderful. Is there a minimum level of either real estate or assets in general overall that it kind of makes sense to move up into a specialized human to help?
Like, is there a breaking point financially, like a generalized dollar amount that makes sense more for other people?
Well, that's pretty subjective depending on the individual. There are some people that will just tell me, I can't deal with this. It stresses me out. I really don't care. Just get it done correctly for me. And as long as they're willing to accept our fees, it works out to be a great relationship. There are other people who, if they can't recognize the value or do not recognize that the value exceeds their own time, they're better off going to a simpler situation or even using TurboTax.
And what is the biggest difference between a CPA firm like yours and like TurboTax or, H&R Block?
Well, we have thousands of hours of training where Liberty Tax and H&R Block probably train their people for 20 or 30 hours for each season. We have college degrees. We have sat for and passed the Certified Public Accountants exam and met all the requirements to become a CPA in our separate states. So there's a lot of pre-work that goes into it. Our standards are far higher for documentation than a Liberty Tax or an enrolled agent or H&R Block, and we are subject to much higher malpractice penalties if we make a mistake.
There's a lot more at stake. So
yeah,
a lot
people
carefuler.
at H&R Block and Liberty Tax Service don't have a license to lose if they commit malpractice. There is no big risk on them. Their job is to be able to focus on producing a tax return, getting the fee, and repeating that 20 times a day.
That makes sense. What is maybe the most common question that people who come to you ask when it comes to real estate tax?
Probably the most common is, how do I buy real estate and not pay taxes?
Is that possible?
It is, but it's not where my focus is.
Is it advisable?
It can be under certain circumstances. I am a big fan of having taxable income from rental property because typically, if you haven't leveraged yourself too much or done multiple 1031 exchanges where you have to pay taxes because you've taken all your equity out, the taxable income from real estate, if you've bought correctly, means that you're making a very high return on your investment.
And
So,
when you
so
talk about a 1031 exchange, Dad, can you tell the listeners at home what that is? Because I think that's, when I worked in your office, that was one of the most common questions I heard people call in and ask about.
So a 1031 exchange is where someone takes a property that they've owned for a significant amount of time. They use a straw man or an intermediary to trade for another property and avoid the taxes on the gain from that property while they go into another one. So the downside to it is you're usually buying a property that's much more valuable, but you're carrying over your old basis from a property you may have depreciated half or 2/3 of the value. So you don't get to use the depreciation deductions of the more expensive house against your income. And if you do that multiple times, you can find yourself with taxable income and a negative cash flow.
Interesting. There is no 1031 company where I am at who is talking about those things because, of course, they want you to transact the 1031 and get their fee for it. I have done presentations to clients in live classes with 1031 experts here in town, and none of them talk about that. That's excellent.
Well, they're not, first of all, they're
not tax people.
They're not tax people. They're very specialized, and they don't necessarily know what the exchanger has in terms of basis for their property. What they know is how to make sure that the exchange works for them. So they're legally exchanging the property. It's not something, if I was just simply an exchange specialist to produce 1031s, I wouldn't bother looking at the tax aspects of the client because A, I'm not a tax practitioner, and B, my job is to do the exchange cleanly and make sure it's correct.
I agree about those things, but in the back of my head, I think they should maybe bring it up that this could be a potential down the road if you are being a 1031 professional. Just have it in the back of your head and mention it.
Yeah.
Well, and I'm sure that there are people who do it. I would be wary that if I was not a licensed CPA and I was doing the 1031 exchanges, that I would be providing professional advice that I'm not licensed to provide.
Correct.
So I think that would be one reason why they wouldn't do it.
That makes sense.
And so the 1031 exchange intermediary is there to make sure that the exchange actually happens and that preferably the exchanger doesn't receive any excessive amount of money or something we call boot that triggers a tax, and make sure that it's done properly. And there's a lot of details to do. It's not a simple thing.
And, with that being said, is there, what would you like our list, given that you have people calling and asking these sorts of questions, what would you like listeners or just people in general who seek you and other CPAs like you out as a professional to know about working with the CPAs, like that they don't know when they come to you?
Well, there are certain decisions that have to be made when acquiring real estate and establishing something called basis. There's an allocation on almost all properties between the cost of the land and the cost of the building. Buildings are depreciable, land is not. So if you're buying a single family residence in a freestanding home, you are likely to make an allocation between your purchase price of the house and the land. If you bought a property for $500,000, you might assign typically $400,000 to the building and $100,000 to the land. And there are other aspects of it where there's a lot of secondhand help in regards to doing certain things that will relate to depreciation. Depreciation is a decision that needs to be made thoughtfully because you could decide to depreciate things differently based on the assets that are inside the house, where you could get more accelerated depreciation deductions up front than in the back end. If you're buying your first house that you're going to rent, there isn't a great advantage to it because the accelerated depreciation figures will likely not be deductible in the year that you've had them, even if you show an actual tax loss, because the passive activity loss rules prevent you from taking a loss on rental property if your adjusted gross income is over $150,000.
Wow.
And the other thing is there are people who like big accelerated depreciation items, like I bought a refrigerator and I'm going to depreciate it over on a declining balance rate, where most of the depreciation comes in the first 2 or 3 years, and a smaller amount in the last 5 years. And the problem with that is when you're taking accelerated depreciation on assets, later on when you sell and you don't turn 1031 exchange, when you recapture the depreciation that you took on those accelerated depreciated assets, it is taxed at ordinary income tax rates, which are higher than long-term capital gain. If you use straight line depreciation and make the election on your tax return to do so, you take the depreciation over the same time. It's just equally each year. And when you sell, you recapture that depreciation at long-term capital gains tax rates, which is much more favorable to the taxpayer and is what I would call classic tax arbitrage.
Now, I know that this is kind of backing up a little bit, but could you explain to listeners who might not know what depreciation is, what you mean when you say depreciation for tax purposes?
So depreciation is practiced in the U.S. It's not practiced all over the world, but in the U.S., we are allowed to depreciate the assets we purchase over a certain lifetime. And the IRS determines what those lifetimes are. You can use what we call modified cost accelerated depreciation, something called makers, or you could use the alternative depreciation system, which they allow you to do, which generally gets you to allow to depreciate over a longer period of time, which means that your depreciation deductions are lower. A person's individual tax season would dictate why somebody would do that. And typically most people, at least my clients, we use modified accelerated cost recovery systems, and we use straight line depreciation so that the benefit to them when the deal ends is they have a lot more money in their pocket, especially if you live in the Bay Area or Portland and you're making $300,000 or $400,000 a year. The difference between long-term capital gains and your ordinary tax rate on $50,000 could put $12,000 or $13,000 more in your pocket simply by using straight line.
Wow. That's amazing. It's interesting. I grew up around this my whole life, and I'm learning things in this call that I didn't know. That's pretty cool. Shannon, do you have any questions to add to that?
Yeah. Are these things you're talking about, are they anything that someone could think of and be planning for in advance of purchasing an investment property, or do you just buy the house and then figure it out when you file taxes?
It's something that my clients will call me for in advance, and we'll look at it from the standpoint of what the impact is going to be. As I said, I'm a big fan of taxable income on your real estate because it means you're getting a good return. I'm also a big fan on having a lot of skin in the game when you're buying real estate. For a lot of people in the first decade of this century, there was a lot of freewheeling and buying real estate without having to put any money down. And it made a lot of sense to people when they could do it and the prices were rising and they could flip it in a short period of time and make a lot of money. But in 2008, all that reversed. And a ton of these people who had no skin in the game walked away from their real estate and lost the opportunity to recoup that money when it came back in 3 or 4 years. And the reason is they didn't have any skin in the game. And it was a lot easier to walk away from something that you had no money in.
Yeah. Much easier. I think this all harkens back to, what Shannon and I are always telling people is like, you need to have a good team behind you so that you can make that decision wisely and you can choose the right investment. Your clients call you because they have you as a resource. My clients call me or they call Shannon because they have us as a resource. And I think I want to drive that point home for the listeners that it's so important that the team that's around you can give you solid advice so that you can make wise decisions. And
all of those services are very important. If you don't get taxes right, you've blown. It's very hard to undo, and you're missing huge opportunities.
And it could cost you money and penalties.
Yeah.
I will say this. I think a lot more people could buy and invest smartly in real estate if they approached it from a different perspective of trying to own it all by yourself. Traditionally, in the early stages of my career and from the 50s, 60s, and 70s, most people bought real estate with partners. So if you didn't have the 20% down to buy the piece of real estate, but you had 10, you would find another person who had 10 and you could buy the real estate and get started and make the investment. And the difference is that you'd be splitting the profit with somebody else. And the alternative is if you don't have enough money to buy to get in, you won't be making anything. So partnerships are a great way for people who are starting out investing to get started with real estate.
Yeah,
That's excellent. Yes, I doing mortgages. I don't see that often. It's hard to think through and find your people to invest with, to find the right partners. So what it usually comes down to is it defaults to family instead of actual partners, and then that gets even stickier.
Yeah, if you're buying a house that costs $500 and the optimum mortgage rate needs 20% down, it's a lot easier to do it with 4 people who have $25,000 than trying to do it by yourself if that's all you have is $25,000, because your rate of return is going to be identical if you had the $100,000 or you only had $25,000. The amount of money won't be as large, but the return on your investment will be identical. And when people buy stocks, they don't think about that. They'll think, well, I get an 8% yield on this when they're buying stocks, and they can go in with very small amounts of money. When you're buying real estate, you get the same return. You just have to share the overall return with 4 people, but the rate is the same. And it's an easy way to get in. And it's an excellent way as a young person to get into real estate. And almost everybody that I know that has done that has been able to get to a point where they've had their own money to buy by themselves later on, simply from the amounts that they invested with other people.
It's part of why getting on the ladder is the most important step.
That's right.
And being creative and thinking outside the box of how you do that, like partnering with a friend or a business partner to get it done.
Yeah,
that's awesome.
If you go in with $25,000 with a group of friends and you can double your money over a period of 7 years, then you have $50,000. And if you can do it again over 7 years, you then have $100,000 where you can then go out and buy your own real estate with your own money and have and grow your investment portfolio. It's a time thing.
And that's not even counting, you're talking about the return when you sell the property, correct? And
we're not
equity.
talking about your return on your investment. You're also looking at what's my cash on cash return. So if I've got $10,000 of positive cash flow a year on $100,000 of down payment, my cash on cash return is $10,000. So that's a 10% return. It becomes much more effective when the taxable amount is only $3,000. It does make your effective return somewhat higher than that, because if you're in a 24 to 40% tax bracket, you're going to lose a quarter to almost half of your income to the state and federal government. And that happens with stocks. It doesn't always happen with real estate because you're entitled to take depreciation.
Nice. And so would you say then that you encourage, I know the answer to this, but would you encourage people to invest in real estate as part of their, a significant portion of their income strategy?
Yes. And a lot of times when I'm doing an initial interview with a potential client, we talk about having a diversified retirement portfolio or a diversified investment portfolio. And one of the more common answers I get from some of these clients is, well, in my 401k, I have stocks and bonds and REITs and other investment vehicles. And those are great. They're absolutely terrific. The problem with that is that that money, when you eventually take it out, is always going to be taxed at ordinary tax rates. You do not get the benefit of long-term gain tax rates or the ability to take money from it without having to pay tax. So we talk about a diversified retirement that includes qualified money, which is IRAs, profit sharing plans, and 401ks. We talk about having an investment portfolio with a brokerage house that is outside of your retirement plan. We talk about a real estate component. We usually talk about an annuity component, and we talk about a retirement plan component. So the real estate is one of those places where you can draw money when you need it based on equity or cash that you've saved to purchase items that don't that you would trigger a bigger tax on if you simply had to pull the money out of your 401k to pay for it. So if I have an equity line, or I have $100,000 in my real estate accounts and I need a roof for my house, I can pull the $50,000 out of that. That money's already been taxed. I then pay for my roof with money that I've saved. If I only have it in my 401k, I've got to take out $90,000 to buy a $50,000 roof. And that really burns my future.
Yeah. And Shannon, that would be you then that they would come to for that, right? You would use refinancing or some sort of financial product through a lender to realize that equity, correct?
If you need to use equity to get that money, yes. Or if you are saving your cash flow and putting it into an account, then you have that cash sitting there without having to tap equity. Sure. One of the big... No, go ahead.
Sorry, was that done?
I will tell you the story of my favorite real estate agent and the most successful real estate investor I know. She's a gal here in Colorado Springs that knows this market better than anybody. And her and her husband probably own 35 high-end residential properties, and they own them free and clear. So their cash flow is phenomenal. The husband was a meteorologist, and the wife has been a real estate agent. She sells property. She is the best real estate agent I have ever worked with. She has assisted my family in 7 or 8 purchases. And she understands how to make money in real estate. And if you think about it, this is somebody who's done this over 45 years. Her family now has this $30,000 to $40,000 a month positive cash flow just from real estate. And it doesn't, and that's before any of their retirement plans. It's before Social Security. It's before other sources of revenue. And they've done it methodically, and they've done it the correct way, and they're patient. Real estate always pays in the long run if you're renting, because you're getting the opportunity for somebody else to make your mortgage payments while you own the real estate.
That's exactly where I was headed. Is one of the main things I've taken away is none of this is fast. Earlier, you gave an example of a 7-year turnover, and that person there who's done it over years. None of this is fast. I talk to people all the time who are like, I'm going to flip a house and I'm going to earn a bunch of money this year. That happens very seldom, and very seldom does it work out well for people. This is long-term.
Well, I have a story from one of my clients. He's still a client. He's doing very well with it. He and his new bride, but he got into real estate. He was an engineer in Silicon Valley, and he bought some property really well, and he flipped a house and he made a lot of money. And his next approach was they decided they wanted to do 3 deals. And it's very common to watch people do this. And the next 3 deals, he lost his shirt. And he was back to square one. And he told me exactly how he did it. He knew it was his own fault. And the issue was, from my perspective, it's like the phrase, pigs get fat, hogs get slaughtered. And it's an assumption of too much risk. House flipping can be very lucrative if you're well informed and you know how to do it. But I've never met a house flipper that's made money on every one of their transactions. Sooner or later, they get hammered someplace.
It's a numbers game usually for ones who do it as a full-time job. You win some, you lose some, and they balance out in the end.
Yeah. That's right. That's right. Now, this same particular guy has continued to invest in real estate methodically, and he's doing quite well. But a few years ago, it was bum city for him. And house flipping is for the educated and well informed. And like there's an old saying that a rising tide lifts all boats. And if you buy at the wrong time, which would be the peak, you will end up losing your shirt. But when things are going up, it's an easy way to make 6 figures every 4 months. It's just when things are going down, if you've exposed yourself, going from one house to one house to one house, from one house to 3 houses to 7 houses, you can get yourself in a lot of hot water.
And it's more of a gamble too, because you don't necessarily know when the bottom's going to hit. You don't know when the peak is going to hit. It's why the long game is a safer investment and a better investment strategy, because if you hold it for long enough, you will make money.
And some of the best advice I got from my father-in-law, who told me, whenever you're doing business, always leave a little profit in for the next guy, because that way you always make money.
I like that. Grandpa Jack said that.
Grandpa Jack. That was Grandpa Jack's. Jack told me that probably in the early 90s.
He was a wise man.
There are people who make a lot of money. They're few and far between. They're the Elon Musk. They're the guy who started Dell. And a lot of people who made money in a hurry starting companies. And they're very few and far between. There's a lot of people in tech that have a base salary that's, $150,000 to $250,000, and they're making a ton of money because they have stock options. And all of them at some point see a reversal in that. But think about it. If you're going to build wealth quietly and under the radar over a period of time, you're learning the discipline skills of investing, making sure that you're not being foolish with it. And the compounding of money over a period of time always adds up. And if you're all said and done at 70 and you're ready to retire and you've got a nest egg of $7 to $9 million of assets spread over a bunch of different areas, just like we discussed before, you're done, right? And you've done it in the period of time, and you have not exposed yourself to a lot of risk.
I like that. Well, Dad, I think that's a really good note to end on right there.
Agreed.
Great. Thank you so much for coming on our show, Dad. Dad, if anybody wants to connect with you and your team, where should they find you?
www.scottportercorp.com. They can reach me at my direct line at my office at 719-266-3546, or my work mobile phone 415-699-6130. And email is scott@scottportercorp.com.
Perfect.
Well, thank you. Thank you so much for being here today, Dad. I really appreciate your time. This has been really educational for me. Do you have any other questions before we go, Shannon?
I think we covered it all today. That was excellent.
Again, thank you for being on the show, and we will see y'all next time.